Okay, so if you've been anywhere near the news lately, you know that feeling, right? Just anxiety.
Oh, absolutely. It's everywhere.
You've got the Supreme Court talking tariffs. You've got the endless drama around potential government shutdowns.
Don't forget a Fed. Every word gets dissected.
Exactly. The whole financial market just feels like it's gripped by this relentless uncertainty. Investors are definitely feeling it.
Totally saturated in negative headlines. It's a lot. And yet, the sources we're digging into today, they bring in this voice, Mal Madison, who's just remarkably calm.
Yeah, almost like stubbornly bullish, right?
Yeah.
Totally. His message cuts right through the noise, basically. Calm down. Everything's going to be okay.
Yeah.
Calm down.
Yeah.
I mean, that's easy to say sometimes, but he's saying it now when sentiment is, pretty shaky.
Mm.
So that's our mission for you today. We're going deep, really deep into his multi-year bull market thesis.
Yeah, we need to look at his specific arguments, the technical stuff, the structural stuff.
And definitely get to the bottom of that really aggressive call he's making on Bitcoin.
Right. Because Madison seems to think all this anxiety we're feeling, it's just human nature 101. Meaning after the kind of crazy moves we've seen over the last, say, 18 months, investors are just psychologically wired to see any pause, any consolidation
as the beginning of the end.
Exactly. Mistaking healthy consolidation for some kind of major structural collapse. We need to see if the numbers actually back up his calm view.
Okay, let's start with the wider market then, this macro storm. Usually when the market drops, people's first instinct is, well, panic.
Sure. Sell first, ask questions later.
But Madison's saying these recent drops are, very, very normal stuff.
Yeah, and not just normal, but the kind of thing the market should actually want to see.
Okay, hang on. Why is a dip good? Explain that.
Well, it's all about context, right? Proportionality, he points to the S&P 500.
Okay.
It hit new all-time highs recently. Then the pullback was only about 2.2%.
Which sounds small when you put it like that.
Right. And maybe more importantly, that little drop. It only retraced about a third of the gain that came right before it, which was like 6%.
Ah, okay. So if a rally's solid, it should hold on to most of its gains when it takes a breather.
Precisely. This isn't some big reversal signal. It's just the market, catching its breath, taking a necessary pause.
So instead of that scary parabolic spike that just flames out, he sees more of a stair-step pattern, a slower, maybe more sustainable grind higher.
That's the picture he paints. And he also notes why these dips are staying shallow. He thinks the market floor is pretty solid structurally.
Meaning the big players.
Yeah, the institutions, the big banks, the asset managers. They are consistently stepping in and buying whenever we get close to that, say, 2% dip level.
So they provide a floor.
A powerful one. It just absorbs all that typical retail selling, the stuff often driven by scary headlines and media hype.
But what are those headlines? I mean, some of them feel pretty real. Tariffs, potential shutdowns, the Fed doing whatever the Fed's doing.
Right.
How does he just brush those off as bumps in the road?
Well, he sees them affecting, let's say, short-term trading sentiment, the day-to-day noise, but not the underlying economic path, the foundation. And he points to a couple of big undercurrents that are actually providing really strong support, even if they're not obvious.
Like what?
First, the dollar. It's stabilized recently. The DXY, the dollar index, it's settled right around that 100 mark.
Okay, I know the DXY, but why is hitting 100 specifically such a big deal for, like, the S&P 500?
Well, think about it from the perspective of, say, a big European pension fund. If the dollar is swinging wildly up or down, they get nervous. Any profit they make on U.S. stocks could get wiped out just by the currency move when they convert back to euros.
Yeah, got it. Currency risk.
Exactly. But when the DXY stabilizes around a nice round number like 100, it feels more reliable. It gives them confidence.
It encourages that international money to flow into U.S. stocks.
Into the NASDAQ, into the S&P. Yeah, it's actually a huge, often overlooked tailwind.
Okay, that makes sense. Stability is attractive. What's the second big support factor he mentions? This one's simpler, but just as powerful. Seasonality. Ah, the old November-December effect.
Pretty much. Think about portfolio managers. If they've had a good year up to, say, the end of October, they have to protect those gains and hit their annual benchmarks. They need to lock it in.
So they have to buy, or at least not sell.
They're almost certainly adding exposure, chasing those benchmarks. It creates this sort of guaranteed buying pressure heading into year-end, almost regardless of the day's headlines.
Right. Okay, so the general market outlook, according to Madison, is cautiously optimistic, structurally sound, maybe?
Yeah, I think that's fair. Bumps, but a solid foundation. Okay, then let's pivot. Let's talk about where he gets really aggressive. Bitcoin.
Mm-hmm. That $150,000 breakout thesis. It's stunning. What's the exact call? The timeline.
Okay, so he says, and this is a direct quote, Bitcoin is literally setting out for a 50% move by the end of February.
50% by end of Feb.
Wow. Yeah. Starting from that recent low around $98,000, that puts the target just under $150,000.
This is a blistering pace.
Yeah.
Especially since, didn't he have a year-end target that was lower, like 140K?
He did, yeah. His year-end 2025 target is still 140K. So this suggests he sees a really, parabolic surge happening right at the start of the year, Q1.
Okay, a 50% move in 2 months. Even for Bitcoin, that's extreme. What's the technical logic? Hitting the bottom of a channel sounds bad, not good. What's he seeing?
He's focused on the bigger picture, the long-term trend. Bitcoin's been trading in this really broad upward channel for 2 years now.
Okay.
The key part is where it touched during this recent consolidation. It came down and just kissed the bottom of that channel, right at that $98,000 level.
That's the critical juncture he talks about.
That's it.
And why is $98,000 so important? Is just the channel bottom?
It's the channel bottom, but it's also key historical support. He points back to the low that was set during that Iran bombing scare. Remember that?
Vaguely, yeah. A big geopolitical shock.
Right. And the price tested and held that exact same 98K floor then. So the fact that it dipped there again, tested it, and immediately bounced back inside the channel
isn't a sign of weakness. It's confirmation of support.
He sees it as a coiled spring.
Yeah. Confirmation. A great opportunity, he called it.
So that whole consolidation phase, after that absolutely crazy run-up from, 35K last fall?
Yeah, fall 23.
Up past $100K after the election, that needed to happen. The market needed to breathe.
Absolutely. Necessary consolidation. And that leads right into his next point about why this time might be different structurally.
Okay.
He thinks institutionalization has fundamentally changed Bitcoin's market. It's acting like a huge volatility dampener.
Hold on, how does more money, especially big institutional money like BlackRock, reduce volatility? Wouldn't it just mean bigger swings?
You'd think so, right. But it changes the character of the swings. What he finds fascinating is how the supply is moving around.
Meaning?
During consolidation, coins are shifting. They're moving out of the hands of the OG whales.
The early big holders. Yeah, the ones who might dump huge amounts all at once if they get spooked. That supply is moving into regulated institutional vehicles.
Like those Bitcoin ETFs, the IBITs and so on.
Exactly, like BlackRock's ETF. These aren't just random holders. They're regulated instruments absorbing supply in a more measured way.
And when all that supply gets bought up without the price totally crashing?
It fundamentally changes the game. Madison argues that the old crypto cycle, the massive blow-off top, followed by a soul-crushing 70% crash.
Yeah, the crypto winter stuff.
Right. He thinks that's probably a thing of the past.
Really?
Yeah. The market's just too big now, over $2 trillion market cap. Plus, you have all these sophisticated financial tools now, options, futures.
Ways to hedge risk.
Exactly. It all helps stabilize the whole ecosystem, makes it more mature, less prone to those wild, catastrophic drawdowns.
Okay, that makes sense. And underneath all this, you mentioned the debasement trade. Can you break that down simply? What is that?
Yeah, the debasement trade is really Madison's core long-term argument. It's pretty simple, actually.
Okay.
It's basically a bet that governments and central banks, when faced with huge debt problems, will always take the easy way out.
Which way?
Printing money. Or, expanding their balance sheets, quantitative easing, whatever you want to call it. We have these massive sovereign debt bubbles everywhere. Eventually, the Fed, other central banks, they'll have to crank up the printing presses again.
And when the money supply goes up, the value of regular currency, fiat currency, goes down. It gets debased.
Precisely. And when that happens, what looks good? Hard, scarce assets.
Like gold and Bitcoin.
Exactly. He sees that as the fundamental driver supporting both gold and Bitcoin for, the next decade. It's not about the daily news. It's just math, monetary math.
Okay, that's the big picture structural support. But he also listed some specific, more near-term thing, political, regulatory drivers.
Yeah, 4 things he expects to give the market a push pretty soon.
What are they?
The revival of the Clarity Act. That's the big digital asset bill, trying to sort out what's a commodity, what's a security in crypto. Getting clarity there would be huge for confidence.
Makes sense. Less uncertainty.
Second, the potential setup of a sovereign wealth fund. Third, we're likely getting a new Fed chair appointed in the coming months that always creates market buzz and movement.
Okay. And fourth, kind of an interesting psychological one.
Yeah.
He expects some kind of proposed housing emergency resolution. He thinks that could just generally boost animal spirits, overall risk appetite. Okay, quite a list. It sounds almost too bullish.
Yeah.
Madison's a sharp guy. He must have a point where he says, okay, I was wrong. What's his red line? What makes him ditch the Bitcoin thesis?
Oh, yeah. He's very clear on his escape hatch. It would take a massive technical breakdown, meaning the price doesn't just dip below that key $98,000 floor. It crashes below it. And this is the critical part. Stays there for a week without getting back into that long-term channel.
So a decisive, sustained break below support.
Exactly. That would invalidate the whole technical setup for him, signal a real structural shift downwards.
Got it. Okay, zooming back out again to the general stock market. If we ignore the sort of daily political noise, what does Madison see as the real structural risks, the things that could actually derail this whole multi-year bull run he envisions? He flags two main things that actually matter long-term. First, the AI story failing. How so?
Well, so much of this current market rally is built on the narrative of massive AI infrastructure spending, right? Companies like Amazon, Google, Meta pouring billions into data centers, power generation.
Yeah, the demand for chips, NVIDIA.
Exactly. If that narrative suddenly collapses, if companies pull back hard on those infrastructure plans, if demand for high-end chips dries up, then the main engine of this bull market just stalls out. That's a real risk signal to watch.
Okay, that's one. What's the second? You mentioned something political, but further out.
Yeah, looking out to 2026, the risk there is a fundamental shift in the political and economic environment. If we saw, say, a very strong showing by socialist-leaning Democrats, as he put it, leading to a major reversal of the current administration's sort of pro-business stance, thinking big tax hikes, rolling back deregulation, that would be a genuine structural threat to corporate earnings and the market's path.
Right, a fundamental change in the rules of the game. But that's a couple of years away. What about right now? Madison admits there were some worrying signs in the stock market currently, doesn't he? Negative technicals?
He does, yeah. He's objective about it. The big one right now is low breadth.
Explain breadth again.
It's basically how many stocks are actually participating in the market's rise. Right now, only about 39% of stocks in the S&P 500 are trading above their 50-day moving average.
Oof, that's low. Ideally, you want over 50%, right?
Yeah, ideally over 50%.
Yeah.
So this low number suggests it's really just a handful of mega-cap stocks. The NVIDIA effect perhaps pulling the whole index up, while most stocks are actually struggling or falling.
That sounds unhealthy.
Yeah.
Weak foundations.
It is technically weak, yeah. And he notes other signs, too, like the VIX, the volatility index, picking up. General sentiment feels a bit shaky. He mentioned things like Michael Burry's famous put disclosures getting attention, or how the market reacted negatively to Meta spending plans.
So, with all those red flags waving, why isn't he more worried? Why the calm?
Because he interprets it differently. He sees this low breadth, this shaky sentiment, not as the start of a systemic collapse, but as healthy rotation.
Rotation, meaning money moving around.
Yeah. He argues the selling pressure is mostly concentrated in what he calls the froth stocks.
The ones that went up like crazy.
Exactly. The companies that maybe ran up 200%, 300%, 500%, and were just overdue for a correction, maybe 20, 25%. He thinks this weakness is contained there, and those negative technicals will get worked off relatively quickly.
Because that institutional buying floor is still there underneath.
That's the thesis. That floor provides the cushion.
Okay, that brings us to one last really interesting structural idea he brought up regarding geopolitics. He called it White House Asset Management, Inc. That sounds provocative.
It is provocative, yeah. What he means is that Washington isn't just a passive regulator anymore.
Okay.
Because the U.S. is now on, as he puts it, a quasi-war footing with China, national security has become a major economic driver. The government is actively stepping in to support key domestic industries.
Like chips, rare earth minerals, things needed for self-sufficiency.
Exactly. Think semiconductors, critical minerals, boosting domestic manufacturing capacity. The government is taking prescriptive actions, providing funding, easing regulations to make sure these vital industries thrive at home.
And this isn't just temporary stimulus. It's a longer-term shift driven by national security needs.
That's his argument. It's structural support and likely nonpartisan because the underlying driver, the competition with China, the need for sovereignty isn't going away regardless of who's in the White House.
So paradoxically, this geopolitical tension actually creates a bullish tailwind for certain parts of the U.S. economy.
A fundamental bullish tailwind for the U.S. industrial base, yeah.
Okay, finally, let's touch on the biggest short-term geopolitical risk he flagged. Something potentially happening soon. He mentioned Venezuela, an April surprise.
Yeah, he did flag that as a significant near-term risk, especially with reports of U.S. aircraft carriers moving down towards the Caribbean.
What would be the market impact if the U.S. did take military action in Venezuela?
He thinks it would definitely cause a sharp negative reaction initially, probably a 5% to 10% drop in the major markets, happening pretty quickly, maybe within a week. Markets hate that kind of surprise, that uncertainty.
But, and I'm sensing a theme here, would that be just another bump in the road? Not a structural game changer?
That's exactly his take. It would be a shock, absolutely. Similar to the initial market reactions when the Ukraine war started or the conflict in Israel flared up.
A drop then, adaptation.
Yeah. The market would likely drop hard, but then it would get used to it, process the new reality, and eventually recover. Because those underlying supports we talked about, the institutional flows, the debasement trade, this government push for sovereignty, they'd still be intact.
So these geopolitical flare-ups are serious. They cause short-term pain, but they don't derail the main structural trend he sees.
That's his argument. They're hurdles, not trend killers. Okay, so let's try and synthesize all this for you, the listener. Mel Madison's core message seems to be, look past the noise, the anxiety you're feeling, the scary headlines. That's mostly psychological.
Underneath, there are these powerful structural forces working in favor of the market, and specifically assets like Bitcoin.
Yeah, things like the institutionalization, changing crypto structure, the unavoidable long-term debasement trade thanks to government debt.
And even this new dynamic of Washington actively supporting key domestic industries for security reasons. These are the big, slow-moving currents.
And they're all pushing generally upwards, providing strong tailwinds that, in his view, dwarf the short-term headline risks.
So his advice, quite clearly, is don't panic. See this as an opportunity.
Unequivocally. He argues this current dip, whether it's the stock market's mild pullback or Bitcoin touching that 98K channel floor, is a chance to take some risk and add exposure.
Because he sees the stage being set for that next big leg up, especially that potential parabolic move for Bitcoin towards 150K early next year.
That's the setup he sees.
It's a compelling case for, well, having conviction and maybe some patience. Now, Madison also basically says, get used to volatility.
Right.
He expects more big daily swings.
Yeah, more 1% days for stocks, more of those big $5,000, $6,000 daily candles for Bitcoin. Volatility is part of the package now.
Okay, so here's the final thought we want to leave you with. If Madison's right, and this higher volatility is just a feature of a market in a strong uptrend, not a sign of failure, how should you personally adjust your own thinking, your own risk framework? How do you learn to treat that volatility not as a bug, but as just part of the ride higher?
That's the big question, isn't it? Something to chew on. Thanks for diving deep with us today.